Let's bring in Karen Karniol-Tambour. She's Bridgewater portfolio manager, head of sustainability. Karen, have your thoughts about the economy and the markets changed after the Fed meeting yesterday?
Well, I think that the market action today represents what's been happening in people's minds, which is the realization that until now, you've basically had a lot of tightening priced in, a lot more expected Fed catching up. But actually, the sell-off in stocks and in risky assets is pretty much was just pricing in higher discount rates, higher interest rates, and basically not at all pricing in that economy will actually reasonably slow. So if you think about a stock as, it's a forward series of cash flows discounted today, only the discount had changed, only the discounting. And then today's market action. Today's market action actually looks like what I'd expect would happen from here, which is the realization the Fed is now going to tighten a lot. There's a lot of tightening now priced in. You now had a big contraction in stocks. The economy has to start slowing from here. So now you have a day where treasury yields don't move, stocks actually fall. That's telling you that actually the path of earnings is being discounted to change. There's actually an economic slowdown starting to be priced in. But it's, maybe the first day of that move. And I think there's a long way to go with how much the economy will have to fall getting priced into the market.
So you see a lot more market pain from here, even though we're already off about 25% on the S&P, about 35 almost percent on the NASDAQ.
Yeah, I would say without the Fed blinking, without the Fed saying, you know what, I'm just going to tolerate higher inflation, the amount of tightening they're going to do is going to cause a lot more economic pain than what's priced into stocks. That decline in stocks is pretty much just a reflection of higher interest rates. Doesn't really have any pricing for a worse economy, for more volatile inflation, for the risk premium associated with that. So unless the Fed blinks and says, I'm going to live with higher inflation, which they might do, it is really painful to tighten into a falling economy. You're going to have more pain in risky assets to reflect that.
So it's clear what you think about where stocks are headed. What about bonds, though? And that if we have moved on to the pricing in of the economic slowdown from the rate hikes starting to be priced in, should you buy bonds?
I think that the front of bonds is kind of uninteresting. On the margin, maybe I'd buy a touch. There's a lot of tightening priced in. It could kind of go either way. We went from a place where bonds were extremely unattractive because there was no tightening priced in to saying, look, a lot's already priced in. The Fed could go a little faster than that, but they could also blink and go a little bit slower. Long end, I still think is a sell because you're still in a situation where all the QE money is coming out, where you just have such a liquidity hole, and there isn't that much tightening priced in past a year or so from now, and inflation's likely to be pretty sticky past that.